This roadshow is brought to you by ResearchBytes.com.
So, can I request everyone to take your seats? There are some folks who are going to Bombay who have to take catch the 8 o'clock flight, which means they have to leave here by latest 6. So we'll try, we've got an hour and a half, and we'll try and go through that as quickly as possible. So thank you very much. I know it's a long trek for most of you. We appreciate you being with us this afternoon. I hope in the next hour and a half I'll make it worthwhile, or you will make it worthwhile by your questions. I've got a short presentation. I will take you through that. Before I go through it, I just want to place one disclaimer on the agenda, which is all the disclosure norms that have come in. I have nothing to hide, but there are certain things from you. I have nothing to hide from you, but that I have some things to hide from competitors. So there may be some questions that may be competitive in nature. If they are, I will admit that they are, and I will not respond to them. Because if I do, then it becomes public domain, and I don't think it's in our collective interest for those guys to get to know about us. So that's the only thing that I would like to place on the agenda. So we'll move forward. One quick slide that for some of you who have come in for the first time. This is the background. That's my grandfather and my father in the left middle, and his brothers who started the business. Way back in 1918, started as a bus company, fleet of buses, 2 airline companies, all nationalized, then went into manufacturing in 1959. Elgi was started in 1960 as an automotive equipment company, because that was our knowledge. We knew how to build buses, service buses, so automotive was our forte. So we moved into automotive equipment, basically lifts, greasing equipment, washing equipment, and we needed a small compressor for inflating tires, and that's how we got into the compressor business. And then we grew the compressor business, which is about 90% of our company. So that's just a brief background. All our main and our adventures are all there. We'll talk about them. And this is our new facility. A little bit of a statistic in the bottom. We have enough land here to move our main campus here. We hope that the way our cash flow plans are, and we'll share a little bit with you, we should be able to comfortably start looking at moving our entire facility 4 years from now. We'll start building 3 years from now and probably move on the 4th year. So that's a very broad plan, unless we hit a deep gold mine, and then probably if we do that, then we will move a little earlier. Right. So, little bit on technology. Again, for people, most of you have seen it, some of you have not seen it. We make the widest range of what is on top is really the heart of a screw compressor. The rest of it is peripherals, a drive, cooling system, valves, but that's really the heart of it. For those of you who went through the plant, the 2 rotors and the housing, that's really what the compressor is all about. We make the widest range of errands in the world, starting from the smallest, which was more a technology demonstrator, to the largest errand on the right-hand side. Some of the encapsulated ones for the lower end of the market is what we produce. Go on, Mani. We make now a wide range of oil-free screw compressors. With that range that we have, we've pretty much covered the full range of oil-free, both single stage, low pressure, air-cooled, water-cooled, and 2-stage high pressure. So we pretty much have the full range now. Centrifugal compressors, basically there are 4 frames. We have completed 2. In the next 2 years we will complete 2 more, and that will give us the complete range of centrifugal. With this, pretty much then we are one of 3 companies in the entire world that has the full range of products. Both not just products, but the technology and the knowledge of building the products. So this is our oil-free machine, very nice looking machine. Go on. Our oil lubricated machine, which is the premium range, the high-end range, which is either the direct drive or the gear drive. Go on, Mani. This is the belt-driven lower-end machine. We have 2 different range of products to cater to 2 different segments in the market. Go on. This is a portable range of machines. Diesel driven, this is electric driven. Go on. These are our range of machines that we produce for the railways. Railways, interesting business. It's a very India-centric business. There are 2 segments in railways. One is the intercity railway, and then the metro. Our presence in metro is almost 0, but we have a very large presence in the intercity. The intercity railway, it's not because of our technical capability of the product. The intercity locomotives are made in India, and therefore we are homologated to supply to those locomotives. But the metro electrical multiple units are all by either Siemens or Bombardier or Kawasaki or Rotem, where the homologation process is not in India. It has to be, it's a very long process, and it's like the automotive industry, very tight relationships that are very difficult to break. So we are focusing primarily on the intercity Indian built locomotives. This is our range of our piston compressors, primarily low duty cycle, small and medium sized industry products. We also have a full range of oil free in pistons in the smaller size. So if you look at us today, we are probably the only company that has the complete range of oil free machines, starting from a piston which is 1 horsepower, going up to a screw compressor which is 600 horsepower, or even a centrifugal which is 2000 horsepower. Accessories and stuff. Okay. So it comes to the interesting part. This is pretty much how our business looks. 90% of our business is compressors, 10% is automotive equipment. Out of our compressor business, 67% is India, 33% is the rest of the world. Now, if you look at what we supply from India to the rest of the world, that rest of the world number may go up a little bit more. So that part is not included in that. That's taken as India business, right? So if you look at the region, ISAME is India, South Asia, Africa and Middle East. So South Asia is Bangladesh, Sri Lanka, Pakistan, if they like our products. COSIA is China, Oceania, which is Australia, New Zealand, and Southeast Asia. America is Europe. International division is our trading business, meaning to many countries we just trade. They may buy 2 machines a year, 1 machine a year. They're basically countries like Ivory Coast or Kazakhstan, Turkmenistan, some very strange sounding countries. So that, but that is still, that's organized separately as a division. So if you look at our sales performance, nothing to write home about. What the reality is, our estimate for 15-16 is we are inching very close to our 13-14 number. 13-14 was our highest when we did all our acquisitions. We completed most of our major acquisitions in 12-13. And 13-14 was really the year when most of the acquisition values came into our top line. So we're inching we will exceed that, but we really should have been at a completely different level. We'll talk about it. So India is 8267, which is about the same 60 odd percent. But again, like I said, what we supply from India is also embedded in India. So go on. Our EBITDA, again, not something that you would like to write home and celebrate, but the interesting thing is the losses that our subsidiaries were incurring are now turned positive on a consolidated level. Across subsidiaries, they are beginning to make money. Now, I think the future looks only positive on that dimension. In the last meeting that we had last December, we talked about managing the business for cash, and we said we're going to have some aggressive plans to bring inventory down, receivables down, and debt down. And I think we've done a reasonably good job getting the inventory levels down. Our plan was to reduce the total total inventory down by about 60 crores, and I think we are on track to make that happen by the end of the year. Go next. So receivables, similarly, we have very tight controls over them, not just in India but globally. And if some of our big project friends in India behave themselves and pay us, all the power plants and cement plants and steel plants, I think we would have been in a much better situation. So the net debt is our estimate. We started off at almost 290 crores. We expect to close with about 220. So we said we're going to bring it down by 60. We'll probably do about 70 crores. Right? So this is a synopsis of our performance. Generally speaking, industry-wise, let me take you through. I'll start with India and then kind of meander around the other regions. India performance is in the back of two things. One, the water well business has picked up, and compared to the prior season where we got left behind, we've caught up and we're getting ahead. So that's one thing. But for us, internally, looking at the water well business is a bonus. When it comes, we leverage it, but we don't really plan our business around it because it's highly seasonal. Besides that business, we have also had good growth in some of the industrials, not the large industrial projects, zero on power, zero on steel, zero on all the big ones, but balancing investments by most companies we are beginning to see. So if you look at our own factory, we probably will not be making huge investments in this factory for the next probably 2 to 3 years' time. I don't see anything big happening here. But constantly, there is a need for balancing equipment. We are beginning to do that, and we are beginning to see customers doing that. So those are smaller machines, volumes are more, values are less. So we're beginning to see that happening. That has contributed. Some of the international businesses, our subsidiary growth has been there in some of the things. So overall, it's been a combination of domestic, some verticals and domestic beginning to look up. Whether they will start climbing up is difficult to say. To answer your question that you raised, what is the growth that one could expect in the compressor business? Typically what we do is we look at expected GDP multiplied by the inflation rate. We combine these two, we pretty much then know at a base level, without any improvement in market share, that level of growth we should have, right? But that's a very aggregate kind of an estimate. If you look at, we are in the capital goods business, Unlike a direct consumption related product, our products are bought in steps. The capacities come in steps, not in a continuous curve. So as a consequence, you will have a lead and a lag, but if you take a longer period of time, that formula pretty much works. So it depends on, in a particular year, where you are on that curve. So at a minimum, we tend to have this kind of a growth. Unless, like 3 years ago, when we had this massive build-up of capacity, and then the markets went down, then even the GDP growth and the inflation was sufficient by the existing capacity. So you had that kind of a problem. But over a longer period, it kind of normalizes. So I hope I answered your question on that one. Right? So I think things are looking a little positive in India on the top line. The bottom line, I think we've had good control over our costs, both variable costs as well as our fixed costs. There was really no opportunity for any great shakes price increase. In a market like this, you don't talk about price increase. So we held on to prices. In some areas there was some erosion of pricing, but we've had good control over our costs, both variable and fixed costs. Sure, commodity prices have helped us. Steel in the beginning of the year was something like 32, 33, and now we're at around 28. So we've got some gains from that. So whether that will continue, I think 2017 it will continue. I don't see a problem, but beyond that it's very difficult to predict. But in any case, once commodity prices start climbing up, I think the market frees up a little bit for also price recovery. So I think we should be all right to balance one against the other. Going beyond India, Middle East, which was a strong market for us, was quite disappointing in this year. I think it will be disappointing this year, and primarily because of the oil prices. But there are some indications of recovery because countries like Saudi Arabia have realized that dependence on oil-based economy is not sustainable. They're using some of their money to create an industrial base, so therefore there's some activity that's beginning to happen. Africa is a serious patient. Most countries in Africa are in quite bad shape. So we'll have to wait and see. Countries like Nigeria, Algeria, which are all oil dependent, have been in very bad shape. Moving up into Europe, Bel Air continues to be a challenge for us. It's beginning to become very difficult for us to do business there. Markets are good, products are well accepted, but we have serious issues in talent and the engagement of people. There's a problem, and costs of people. Right? So we are in the process of figuring out a much more permanent solution rather than an incremental solution for next year as far as Bel Air is concerned. Rotair continues to perform well, except that we had a setback in Algeria, which is a big customer. Besides that, the rest of the businesses have grown. Our industrial machines, which are made by Elgi for Rotair, have grown very well in the market. So overall it looks good. We'll have to wait and see the recovery of Algeria. But the interesting thing is, because the product mix has changed, our profitability has improved by almost 2 percentage points there. So which is a good thing, which is a good sign. And when the recovery happens, we hope that the company gets used to a new level of profitability. US, there are two aspects to US. Our patents, which was the distribution company that we acquired. After we had these problems initially because of our people getting recruited away by the competition, we've struggled to get back to the original levels. Right? We've had problems. We are working on it. It is still a challenge. But I'm not too, I would not, ring any alarm bells as far as that is concerned. Our own subsidiary, Elgi USA, which has been set up to manage all the distributors, including patents, has done well. It has grown by almost 45%. We have added a lot more distributors than patents. So things look positive. The acceptance of our products in the market has been exceedingly good. So, and the losses, the past year's losses, that is 14, 15 losses in that business has gone away, right? So coming down to Brazil, operationally we did very well, but the reais depreciated and we have booked a huge loss this year primarily because of the exchange rate. And the exchange rate loss is not because of the import transaction, it is primarily because we had dollar exposures in the form of loans to the parent company and in the form of dues, supply dues to the parent company. So all those were getting restated and that was a loss. So what we have done now is we have done one tranche of conversion of some of our dues into capital because it anyway requires a certain infusion of capital. The second tranche we have converted it into a local reais loan, and the third is there is a loan going to come from Elgi USA into Elgi Brazil in reais. So the whole debt exposure will get converted to reais so that loss is going to get eliminated in the future. So I'm very positive that's why when I look at the EBITDA of the subsidiaries in the future years, it will be much better. Going east from India, most of the Southeast Asian countries, our sales levels were marginally better than last year. Our biggest country in Southeast Asia was Indonesia. Indonesia was also is coming back from an oil shock, now beginning to realize what needs to be done in the industrial space. So we're quite confident that next year would be a better period because it's back on track to growing. China, like I explained in my calls after the quarterly meetings, we have shrunk the size of the business down. We have completely shut down manufacturing. Machines are being built in India and shipped to China. We have reduced the size of our building, the warehouse and everything. So we are now evaluating what's next in China. So the losses would be substantially lower, but we have not eliminated them, right? So there will be some continuing losses till such time we put our strategy in place. So that kind of sums up the operations globally. In terms of our new products, our products have been it's been very, very heartening to see our products are getting accepted in all parts of the world. Our quality levels have been exceedingly good. Our warranty costs are very, very low compared to globally known benchmarks. We are at a fraction. So things are very positive on that side. Technology development, our roadmap of what the future is going to look like, how do we build out value proposition to customers that is really compelling. These things have been identified and put in place. So we have, on that dimension, I'm very confident that there's absolute clarity and it is in our control and we'll be able to deliver. Manufacturing systems are continuing to improve. It's an ongoing process. So overall, things are okay. I would not, the results are good, but if we had the top line, it would have been even better. So that's the summary. So if you have any specific questions, I'll be happy to take. Please.
Can you elaborate a bit more on the plans, going forward overseas in terms of
Okay. Yeah. We've done a complete analysis of the lessons that we have learned in our adventures worldwide, and we are very clear that we will not buy any company. Our earlier strategy was we had all these great products, we had all these great technologies. And we had this naive belief that you take this great product, great technology, at an extremely competitive and compelling price, get a local brand, put the product in that brand, and you will make magic happen. It was very naive, right? It kind of happened in sparks initially, but what we didn't realize were two things. One, the local brand brings its own perceptions in the customer's mind, and those perceptions are not necessarily good for us. For instance, in Bel Air, there is a request that we change over to Elgi. There is a better preference for Elgi as a brand than Bel Air. In patterns, we are selling the product as LG. In Brazil, we are selling it as LG. So there's really no need for us to get a local brand. It's actually counterproductive. So that's lesson number one. Lesson number two, you buy companies that don't have strong management talent. Yeah, they actually make things worse for you, right? And the kind of management talent that is required for an unknown brand and a made in India label is a talent that has the ability to persevere. Now, you take most of the advanced countries, or for that matter, any country, the local managers and local leadership's ability to persevere is very, very small. Take India, for example. If a multinational comes in with an established brand and technology, they will hire locally Indians, and the brand will pull the operation. The same India, when foreign companies without the brand come in, they've all failed when they've taken local talent. Invariably, they send talent from their parent organization. Now, we don't have the talent to send to all these markets. We are very India-centric in our management bandwidth. So therefore, we will not look at companies that don't have that kind of management capability. And in our experience, we find we will not find it. So therefore, we are going back to the drawing board and saying, what is our model for growing outside of the country? If at all we make any acquisition, we will acquire probably a distribution company. Our experience with the distribution company, in spite of what was done to us, yeah, is a very positive experience, right? And our experience with manufacturing, not so, right? Increasingly, we are believing that there is an Eastern model of international growth, and for specific reasons. Now, if you look at the Japanese companies in the 70s and the Koreans in the 80s and 90s, when they entered Europe and America, they started off the same way we did. They picked local talent to lead and run their businesses. And most of them failed because the brand was not acceptable. You know, when you have an India-made product, a failure of a very minuscule kind gets exaggerated, first in the minds of our own people working there. Forget about the customer, right? So what happens is their ability to persevere was very low. So that's why if you look at after the initial failures, the Japanese changed their entire model. Even today, in every country, the enterprise leader is still Japanese. They don't take, whether it's an Indian or American or German, they're not enterprise leaders. The enterprise leader still comes from their parent organization. And the Koreans do the same thing. And it's not because of any cultural insecurities or arrogance. It is just that history, we are learning now. We are beginning to see that. So which means then we need to build a talent pool which is capable of building and leading businesses all over the world, and that doesn't happen overnight. So to that extent, our kind of the inflection that we were expecting in our international growth will be constrained by the time required to build that talent. We are thinking about how to do it. It will take time, but it's clear to us that local enterprise talent, local enterprise leaders are not going to make it happen for us, right? So to answer your question, some of these adventures have been quite painful. We've learnt a lot. Fortunately, it has dented the company, but it has not irreversibly damaged it. We know what we will not do, and we know what works and what doesn't work. So we will navigate through those paths in the future. Sorry?
You mentioned that things are looking good on the top line in India.
Yeah.
Could you elaborate on that?
Well, like I said, the balancing investment in capacities are beginning to happen, and that's what we have seen an impact in our sales this year. Yeah, and there are indications that there are quite a bit of capacity that was built up 3 years ago, not in the large power projects like power or steel, but in some of the other industrial segments are beginning to get used up. So they may come to the next round of capacity build-up. So that's why I'm saying it looks a little positive. Across the board, except large projects. Yeah. Yeah.
Follow up with the first question. I mean, if we look 5 years out, what do you see this mix of overseas, rest of the world, India, and what would be the amount of capital or resources you're willing to deploy now towards getting that?
We have a plan which goes up to 2027, and in the first phase of that plan, which is 5 years, we are looking at a distribution of revenue of not significantly different. India will go from about 55% to maybe about 44%. So still we are relying on India as the big chunk for growth. But over a 15-year period, we are hoping that India, it's a wish that India will be about 10-15%. Right? About 50, yeah. Over a 15-year period.
And in this plan, what are you looking at in terms of capex or investment into building talent?
See, the capital equipment for a plant, the main investment at about 15% growth for the next 3 years, we don't need anything big, at least for 3 years. But of course, we are investing in specific technologies, not so much for capacity, but we are preparing for the future. And one of the things that we are looking at is, Indians are cheap today. And because we are cheap today, a lot of our habits are not good for the future. We tend to take on more people than what is required, but the people are beginning to become expensive. But it's happening very gradually. It's not happening like an overnight thing. We see this as a clear writing on the wall, and we need to do something about it now. And if we don't do something about it now, our ability to hold on to key talent will be compromised, because the wage bill that we can afford is limited, and if it has to be spread over multiple people, we can't afford it. Especially in our business, where it's very difficult to first attract young engineers to come and work for us. So we will be making certain investments which will be clued directly towards reducing the headcount, right? But again, they are not big investment. Those are the only kinds of investment that we'll make. In our cash flow plan, we have put a cap of 30 crores a year. I don't think we'll even spend that kind of money. Yeah. That is on the 30 crores a year for the next 3 years. But I don't think we'll, and even this year, I don't think we'll spend that kind of money. In terms of revenue expenditure, is very difficult to tell. We are still trying to figure out what should be our model for building up our talent. But in this context, I think I should step back and communicate or disclose something. See, in any business, there is the back end at a very aggregate level. There's a back end, which is the technology, the quality, the manufacturing systems, the delivery, the whole lot that delivers the product. And then there is the front end, which is your sales, marketing, your service, and a whole lot. LG as a company has really reached very high standards in the back end. In terms of our technology, in terms of our quality systems, in terms of our manufacturing capability, we've reached a very high standard. But the front end is absolutely primitive compared to the back end. Right? Now, this is also clear in the way that when the India shifted about 5, 6 or 7 years ago, it became the flavor of the month or flavor of the year or the flavor of the decade, and a lot of European and American companies entered India, even in our space, right? But we continue to chug along the same way, right? In terms of our processes for the front end. So people were nibbling on our heels and elbows and all that, and our responses were not so good. So there are areas where we have lost, that we have recognized by virtue of a lack of a aggressive process at a very high standard. That is one. The second is, we have this aspiration to build this huge company, but the organization structure, including me and the people under me, is not capable of going to that level, right? So we need to really look at the structure. There's no desperation. It's not like there's a problem today, but there is a problem if we want to look into the future. So we need to resolve these two issues. So we have now almost signed an agreement with a top-notch management consulting company. They're coming in, they'll start in April. It's an 8-month engagement where they look at front-end processes in India, which is then institutionalized and then transported. Today, if we go set up a factory anywhere in the world, we will set up these practices there, right? So we want to reach that same level of standard of process in the front end. The second thing is our own structure, which includes my succession, right? Because I can't be working like this. So there's a time limit, right? So including my succession and 2 levels below me is a structure that we'll be working on, which puts the company on a much stronger wicket for the long term. Yeah. So. Sorry.
If you just have a look, at your numbers,
Yeah.
go out of strategy.
Sure, sure. No problem.
The last 5 years, basically, at a standalone level, the revenues have broadly remained the same. And obviously, costs, the manpower or the other expenses has all shot up. Now, there would have been some price hikes also along the way. So would it mean that, the focus that we had on the international business has actually, ended up as degrowing in the market, or is the market itself degrown? So from a market share perspective,
In India.
yeah, in India, because the way it looks like maybe the absolute volume would have gone a bit lower, considering that top line has been flat for the last 5 years.
Like I said, there are a couple of segments in which we took our eye off the wheel. One was the water well, which we are now coming back. That was a product inertia. We just went to sleep. But we're back on track. The other was certain industrial verticals, not general sales, but certain industrial verticals where things were happening, transformation was happening in terms of the complexion of the players. For instance, if you take auto component, there is a transformation that is happening where a lot more international companies are getting into component manufacturing in India, not the Indian corporate houses, right? So we had this strength in the Indian corporate houses. Now I'm just giving this as an example. So when the new generation or the new players have come into auto component, we are not an accepted brand. It's almost like being in Germany because they're all German or French or Italian companies that have come in or used to brands being sold there. Now, it's nothing but a go-to-market process. Now, our sales guys tend to say, don't go there because they're not going to look at you. I mean, the sale is lost even before you try, right? So, but we need to change those processes, right? So those are the areas where we have slipped, but it's not significant. It's not like we would have grown by 10-12% if we had our act together. I don't think so, right? Except maybe the water well segment.
So, if I can just add on to that
Yeah.
question. So, somewhere 5 years, for whatever reason, sales was not improving, and during that time, the cost structure just kept on moving up.
Yeah.
So, whatever advantage that we could have on the raw material side, just simply went away as far as the costing is concerned.
Sure.
So one point that you mentioned is that you are putting in some investment to actually trim down the manpower. What other steps? So let's say if for next 2 more years or 3 more years, for whatever reason, the industrial production or the consumption will pick up, what levers are we putting in place so that scenario what happened 5 years and back will not get repeated over next 3 more years?
See, if you don't get a basic level of growth, right, over a sustained period of another 3-4 years, then profitability has to get affected, right? You can't cut costs to the point where you start hurting yourself, right? Now, the problem that we have in terms of manpower cost is not so much on blue collar, it's on white collar, right? Our blue collar numbers are reasonable, right? It's not big, but they could tomorrow when the growth happens as per our aspiration, then we will need those numbers, and unless we change the working culture, working methodologies today, then we'll end up having a problem even with blue collar. So the investment that I was talking about is actually planning for the future, not to give immediate solution today. White collar productivity is something that we need to work on. We are working, it's an ongoing process. If you really look at the actual growth in manpower costs in 15-16, in absolute number, converted it into a percentage, is a very reasonable percentage. But that doesn't tell the whole story. We had to let go of a lot of people. Through a process of talent identification, we did let go of people who are on the bottom of the pyramid, right? So even though the percentage increase was between 10 to 12%, the actual increase that you're seeing is 6.5 or 7%, right? But its increase was much more. So there is again, is this can we keep resorting to this for 3-4 years? No, right? But there's constantly something or the other you do, but I would not say that's strategic in nature, right? We have to grow. And this initiative that we are bringing in to make the front end very robust is to create that platform for growth.
If I can ask
Yeah.
you one more. For last 5 years on this standalone, we have invested approximately, I believe 250 odd crores or so. And during that period, the sale was flat.
Yeah.
I believe that, so in that 250 crores, this plant is there. Apart from this plant, what extra has been done, let's say either to improve the operation so that, like one thing you mentioned that for next 3 years for a 15% sales growth,
Yeah.
you don't require any more capex. So this 250 crores has went towards what? So that for next 5 years, we are prepared to some extent?
Sure. See, the biggest investment, big chunk, is this land and building, yeah, which is really doesn't add to capacity, right? Which is really a foundation for the future. The next biggest one is a foundry. That's a backward integration, right? So with that, because the volume is less, the foundry is kind of at break even, but the quality that we have been able to get, the inventory reductions that we've been able to get, the savings in machining that we've been able to achieve is phenomenal, right? So we don't have any regrets in that investment. In addition, we have made investments to build our own machines. You've seen that some of the machines that we, what you saw was the milling machine, but we've also made the grinding machine, right? So what this gives us is a huge step down of future capacity increases. Cost of capacity steps down quite significantly in the future. So that's really what we have invested into the, sorry.
Sir, just wanted to know two questions. One is the oil-free screw compressor and the centrifugal compressor.
Yeah.
How big this segment would get into? How big it would be? And centrifugal compressors we have been developing for the past 1.5 to 2 years.
Yes.
What traction we are getting in that vis-a-vis competitors? And
We have really not, okay, sorry.
And my second question is, after sales service, last time you told it would be the number one or top priority for
Sorry?
After sales service,
Yeah.
it will be a top priority for us.
Yes.
Where are we now?
Okay. The total market size for oil-free screw, again, globally, I'm only speculating. It's not a wild speculation. It's a speculation based on picking up disparate pieces of information and assembling together. It's anywhere between $3 to $3.5 billion. Yeah, is the size of the oil-free market. The centrifugal market is probably around $1 billion. Yeah, so that's the size globally. Now India varies quite violently. If you have the huge power plants that we went through, then the oil-free and centrifugal markets are very big. Steel plants. These are all the ones that suck up a lot of these machines. So right now it's kind of subdued. Yeah, only the past projects that got sanctioned and things that are being kind of we're supplying. That there are no new projects that are coming up. Aftermarket is a priority. We have grown this year, but we have not grown as much as we budgeted to grow, right? Again, it's an industrial activity related. If the customer runs the machine, then he maintains the machine, and then there is a aftermarket business. So it's a reflection of the present industrial activity. Worldwide, we have grown in the aftermarket, but nowhere near what we wanted to, right? So there is a nascent opportunity for our own machines. The tendency for most sales organizations, especially in the Eastern, African, Middle East kind of a thing, is focus more on selling machines rather than trying to sell a 500 rupee filter. Now the 500 rupee filter is very profitable, right? Now you do it once and get the customer used to buying and using that machine, then it's an annuity that keeps coming in. But you know, it's a little strategic for a distributor to think that way. Yeah, so we're getting there. We'll keep improving, but we're getting there. And one of the consulting assignments is not just products but aftermarket in India. Yeah, so the go-to-market process, the front-end process, covers both the products and the aftermarket. Yeah. So,
What percentage of our revenue would come from aftermarket? What is the aspiration?
the global benchmark is about, on average, consolidated across all countries, it would be about 33 to 34%. That's a great place to be. Right now in India, we are probably at around 23, 24%. Right? But you got to understand, globally, aftermarket includes parts and service. Now, we do very little service. Our distributors do the service, right? So in many countries, the larger companies have started buying up distributors. So that business also comes to them. So the 33% is a mixture of parts and those companies doing their own service plus part sales to distributors. So it takes a very high levels of maturity to reach that 33%, but that's the aspiration. That's the opportunity that is there. Yeah.
So basically we will be lower than this pretty.
Oh, absolutely. Well, that's not true. I mean, if we take patents aftermarket is about 60% of total revenue. So.
Yeah, you last time spoke about introducing a new set of machines to China,
Yeah.
which would be lower cost and
Yeah.
much more efficient. And you said it will take a couple of years
Yeah.
for you to get that machine into the market,
Yeah.
and that could happen on a global
Sure.
scale.
Sure.
So where are we here? That's question.
Mhm.
And the other question is, what would be the breakup of the patents revenue in terms of medical air, our own units, and the aftermarket?
Sure.
Compared to when we bought it,
Sure.
and when will we get to the level
Sure.
that we bought it at?
Sure.
That's second. And third, what is your, where do you see the lacuna in the leadership in each geography? And how are you addressing that, at least, say in the US?
Mhm.
Or and how much time would that typically take?
Okay. The Chinese machine, we are at the point of benchmarking. We have bought multiple Chinese reference machines into our plant. So the machine that we built, we actually built one based on the Chinese target, but it was not a machine that was acceptable, right? So we had to go back to the drawing board, and this time we imported machines that were from brands that were the benchmark for it. So when we look at it, we are very confident that we can do even better, because earlier we had set very high standards based on our performance and the cost of the Chinese. Now you try and do both, it's difficult. Now we know what exactly is the performance level that's required. So hitting the cost targets, we are much more confident. Patents, I don't want to give too much data on patents. You will know the when we publish our numbers, you will know the sales. Patents right now, when we bought the company, it had a revenue of about $41 million. Right now, it would be about 28 million, right? 34 million, sorry. 28 is the patenting. 34 million. So, out of that 34 million, about 6 million is medical business, 6.5, and the balance would be the Patents Inc. business. Now, I don't want to give a further breakup of Patents Inc., but what I can say is this one business that is growing in Patents Inc. is our equipment business. Seamlessly from the earlier brand that we were selling, which belonged to a competitor, we are selling more, and we have grown consistently over the last 3 years. So we're quite happy about that. It's only in the disruption that happened in our aftermarket that we are trying to recover, right? Because that's where the problem is. In terms of leadership, we have leadership to do maintenance. Continue on like this, life goes on, it's fine. But to go to the next orbit and to fulfill the aspiration of the company, we have problems. That is where I said the leadership to persevere through the challenges of an unknown brand and a made in India label is a very different kind of a leadership, right? And how long it will take, I can't say. Yeah? I can't say, but we need that in order to make that inflection. That growth with that inflection. Yeah. Sorry, you.
You made a statement saying that at the back end part of the business, you are at least as good, if not better, than some of the local players in this space.
Yeah.
How do you anticipate their response to your reaching this level and your, I mean, essentially any growth that, or large growth that will come to LG will come at their expense?
Sure, sure.
So what response do you anticipate from them and what's
Sure.
your counter response? I mean, how do you see that playing out?
See, the response that they can do, they can't disrupt our development programs, they can't disrupt our manufacturing programs. None of that can be disrupted by them. What they can disrupt is the front end, right? And that's exactly where we are weak, right? So when we want to build out the entire front end, we want to be able to create foundations which are very, very strong, right? For instance, this rebranding exercise that you see is one of the elements, right? Now, this is just the beginning, right? But this is just advertising it and putting it on our visiting card and putting it on our brochure is not good enough. What does this mean at an employee level? What does it mean at a distributor level? When I go and talk to a customer, how should I talk to the customer? How should I dress when I go talk to the customer? How should I smell when I talk to the customer? These are key things of part of branding, right? Now we need to build all this. This is where we become vulnerable, right? If they can disrupt us, it is in the front end that they can disrupt us, right? Whether it is talking about stuff about our product, right? Bad mouthing our product. If we are able to respond scientifically and in a very structured manner, I don't see a problem.
So is there some third-party certification that you can rely on to say that our product is that? I mean, what do you rely on to say that my product is better?
Yeah.
Or, I mean,
There are, those opportunities don't exist in all markets, but there is a institute called the Compressed Air and Gas Institute in America. Now, compressor companies become members of that. We are a member of that. Now, we have an option of submitting a product for independent testing by that agency, and they will publish our performance statistics on their pages. And customers invariably go to their page and look at the relative performance. Now, in the next 1 year, all our products will be number one. Now, you can't, we have not doctored it, right? Competition can't displace us there because it's independently tested, right? So, they can't dislocate us there. They're going to dislocate only in they're going to shut down their business and go away. You know, they've lost so much money in America. They've lost so much money in Brazil. I mean, we keep hearing all this. Customers are a bit, sorry? In terms of performance. It's called specific power. In our parlance, it is energy required to produce a cubic amount of air. Yeah? So that we have the lowest energy footprint. That's what it is. Because if you look at a life cycle of a compressor, 75% is energy. So customers buy their product based on who's the most efficient, right? And if you're right there, then you get the preference. Sorry? Not cost. Because of the power. So this agency will not talk about the cost of the machine. It will not talk about the power. It will talk about power consumption. Exactly. Life cycle cost would be much lower. Yeah.
could you also throw some light on, in terms of the manufacturing cost per compressor? I mean, there is a variety. What is your advantage versus these peers who are per versus these global leaders?
I don't think on a variable cost we are significantly different. Today, you can source anything anywhere in the world, right?
So you talk about having your own machines developed at the cost.
That's on capital cost. That's not on material cost.
Not material cost.
Yeah.
But on the total cost.
See, if you look at a compressor like that, the value of what is produced in that inside a factory, what we produce, don't look at an oil-free. Oil-free is a little bit more. If you take a standard lubricated screw compressor, it's about 30%, 35%. In that 35%, I would say 60% is capital cost. Right? So on that 18% we will gain. So you're not going to have like this big game-changing difference, but these are stuff that doesn't put a load on your balance sheet to get that next round of capacity increase. So it's not going to change the cost structure in any significant way. Yeah? Sorry.
The Chinese product, the Chinese equivalent product that you develop, you can take it to other South.
Absolutely, sure.
You think it can improve your sort of positioning at that cost?
See, it's a very tricky business. This whole branding and positioning is a very tricky business. Now, you need to, our goal is to brand. If you look at the compressor market, on the left-hand side you have all the major players, and then you go to the right extreme, you have maybe a few hundred manufacturers whose total revenue will add up to the guy on the left-hand side. Fragmented players all over the world, right? Now, you got to be very careful. That fragmented thing operates over 200 countries, or I don't know how many countries are there in this world, but the left bulk of it comes from about 50 countries, right? Now, if you want to play on the left side of the market, you need to make sure that the way you position your product doesn't dilute it. So you don't want to bring something too cheap, then you get positioned that way. Yeah? As it is, India brand, has its limitations.
Is there a significant price difference at some certain level?
There is a significant price difference, but there is no significant cost difference. Yeah? That's what we are discovering in China. Well, there are subsidies that flow in through different ways, which is available to a Chinese company, plus their willingness to work with very low margins. And therefore, there's a musical chair of players. There is some guy who's there for 4 or 5 years, and he exits, another set come in and they exit, but that phenomenon is constant. The players are transient.
How big do you think the US market is now? Is there an impact because of oil?
Sorry?
So is there an impact on the size of the US market because of shale gas? Or oil?
No. The oil and gas segment has kind of flattened out. There's no activity there. But the industrial activity, 2015 America grew on industrial activity. 2016 they expect America to grow more than 2015, but on the back of consumer activity, not industrial.
So how big is the market in terms?
The total US market is close to about 2 billion.
And of that, how big is oil and gas? The fracking market?
Oh, we are not even in oil and gas.
So
No, we are not there at all.
what's your addressable market?
That is 2 billion. Yeah, that's air. Yeah. Sorry. Sorry.
On the Bel-Air plant's operation, you said you're probably looking to do some restructuring to your organization.
Yeah.
So is it that we probably go the way, the China way?
I don't know, because Bel-Air France is very complicated. There are all kinds of laws that we need to look at. We are not a company that just wants to up and run. We need to take cognizance of all these. I don't want to say too much till I have a very clear idea what needs to be done. But we definitely have to do something because we're losing money. Yeah.
So the slide which you showed on the subsidies breaking even,
Yeah.
that includes...
It's making money. It's very thin. You
Yeah.
should have seen with a little
That
carefully.
includes ADS, right? The auto equipment.
Yes.
So if we exclude that, I think
If no, we'll still make money because the profit of India has profit on the sale of equipment made to the subsidiaries. You understand? We sell all the equipment from here. Yeah, there is a profit that we make here.
Okay, so you are taking that piece also.
It's not taken in that number that I showed you. So but that includes ATS. So if you remove ATS,
Right.
but you need to add this back.
Sure.
When you add this back, it is still profitable. By itself, no. What is the number of money? Can you show that number? 30 million. It's 3 crores is profit, right? Which includes ATS, right? Or is it only the...
Say India, it is
India is inclusive of ATS. Yeah. So this is not subsidiaries, this is India. So this 30, just to complete that, 30 million plus some more that is on sale of India, from India to the subsidiary. So that's there and all.
Okay, so India includes the ATS.
Yes. This is number is what money? India including
So
ATS.
where I'm coming from is that last year, if I probably look at only compressor business in international,
Mhm.
probably at PBT level we lost some 24-25 crores. Because China itself we lost 12-13
Yeah.
France recovered, but I believe again this year the losses
Yeah.
would have gone up.
Yeah.
Australia lost money,
But this year's less.
less.
Yeah, compared to last.
Still, so that is where the disconnect is that if we had 24-25 crore loss at PBT level last year.
Yeah.
uh,
Can I take this offline and reconcile it for you?
Yeah.
Yeah? But this is real numbers, so you don't have to.
Okay. And on the, so going forward, basically, if we look at, say, growth drivers, say, international, so the strategy which probably didn't work for us is to acquire front end and push Indian
Yeah.
products. But parallelly, we were also doing exports from India. So, in last 3 to 4 years, how the exports from India has grown, and now going forward, how do you see that piece growing and probably leveraging on whatever product development we have done? We have entire range and our aspiration to be number 2. So I'm just probably trying to get a sense.
Well, I don't have the numbers right at the top of my head, but if you look at our entire sales in Southeast Asia is organic, meaning we didn't buy a company, but we do have companies there. We've established companies there, incorporated them, and they are organic in a way, right? Same thing with the Middle East, same thing with Africa, same thing with Brazil. So and same thing with Elgi USA, not patents, right? So I don't have the full sales number in front of me, but all of them combined have grown very well. Brazil has grown quite significantly. Elgi USA has grown significantly. Middle East and Africa, no, they have not. The Southeast Asia has grown more than last year, right?
So, manufacturing operations, we had one in China and we have something in France
And Italy,
and Italy.
Yeah.
So, Rotan is fine. We are doing okay in Rotan.
except for that Algerian market where we have lost a significant.
And rest is all exports from India.
Yeah.
So, today,
Well, patents is not. Patents,
agree.
yeah.
Patents you may be selling some local brands also
No, we are like I said, patent 70% is aftermarket,
aftermarket.
right? In that 30%, there is our equipment and there are other equipment.
Okay. So today the exports percentage from India balance sheet would be how much, and do you see that ramping up going forward?
I don't have the number, Manish. I can give it to you offline. Yeah, I don't have it with me. I don't remember the export number.
And one more thing on the, so India's spare parts is 23-24%.
Yeah.
But international, it was, last year what you said was only 10%.
If I remove patents,
If you remove that.
if I put patents in, that's also a big number, because 70% of that sales is aftermarket.
Yeah, but
Yeah.
that, excluding patents, 10%, we were looking to grow. So,
Yeah.
over there, how do you see that traction building up?
I don't have the number at the top of my head. In all the markets, we have grown both units and aftermarket consistently.
Sure.
But what we are expecting is a disproportionate growth in aftermarket, right? That is something that we need to work on. Right? So if you look at the growth percentage in Brazil, we have grown in both units and aftermarket in the same percentage.
And in India, per se, like oil-free compressors, how has it been doing in the last couple of years and going forward now? Because we had some product gap, you have filled up the product gap in terms of market share.
Yeah. This year, the oil-free in India, we would have grown by about 20 odd %. But again, these are past projects. There are no new projects coming in, right? There are old projects that we are executing. So whether they will sustain themselves next year is something that we need to wait and see. Yeah.
The size is pretty similar to India, right, in terms of compressors?
Yeah. Little smaller.
700
Yeah.
kg.
Yeah. Slightly
That we
smaller.
can
Yeah.
And introduction of, say, oil-free compressors in international market, I think you have got some success in Southeast Asia.
We have. We have some in Southeast Asia, we have some in the Middle East, some in Africa. The rest of it is struggling. We need, again, like I said, selling a standard industrial oil lubricated machine is one level of leadership. Selling a oil-free machine in a market like America is another level of leadership. So we need to build those capabilities now. This is what we're going to do in the coming year.
But have we done that change in the standards that the US market requires? Because last year you did say that for the oil-free you need some different parameters. That
No, smaller machines, which we have developed now. Yeah,
The machine is there.
machine is there.
We just
Machine is there. We just need to know, yeah,
To push that.
right.
Sir, can you spend some time explaining us the size of the market of Portobello? What is the steady state?
I wouldn't like to talk about it. One of the reasons why we lost the market is we talked too much about it, right? So that's one area that I would prefer not to say anything about whatever, if you don't mind. Yeah.
But we
So is it, just one thing, is it that the market has shrunk a bit size or we have lost market share?
This period we have grown.
Not last quarter, I'm saying over last 2-3 years.
We have grown this year in Waterwell. I don't want to talk about the total number. I know that in the past competitors have been listening in on our con calls, and it kind of triggered their appetite to do things, right? Not that I'm worried, but if there is a fire, I wouldn't like to add more fuel into it, right? Just leave it as it is. Yeah.
Has the industry been growing for the
One second. Yeah. Sorry.
So in India, I just wanted to understand, we are seeing growth in basically the smaller compressors
Yeah.
basically right now. And we see some...
No, larger compressors also, but one-off, not the big projects.
Sure.
Yeah.
So the big projects, I think you mentioned earlier that companies like Analysts, the style of working in India, in terms of their inventory or the receivables that they given these big projects, they've succeeded much more in terms of their acquiring the bigger projects compared to us, because we don't want to compromise basically on that front basically.
That's one of the reasons. The other one is we also need to qualify.
Okay.
For instance, if you take power projects, you need to have X number of machines that have crossed like Y thousand hours before you get qualified for participating in a tender.
Okay.
So we are progressively adding our range
Okay.
to get qualified. So during this time, like few years ago, when these huge mega projects, power plants were there, the larger oil frees and centrifugals we had not qualified.
Okay.
So
So say for example, if we see the industrial capex, maybe next few years will be led by the government side large capex, and maybe
Yeah.
after that the private capex will come in. So do you think we will be ready for that private capex whenever it comes in? By then, maybe.
oh, absolutely. Right now we are ready.
Oh, we're ready. Okay.
Now, right now we can. There's no problem at
Even for
all.
government?
Yeah,
Even
yeah,
for- So now the
Yes.
5,000 hours of testing has been validated
Yeah.
and approved?
yeah,
So we can bid.
we can.
Talk a little bit
Once-
about the railways business because
Can I just finish his call? Yeah.
Just whatever I just want to know, where do you think we are in the cycle? Not of course, are we well into the cycle?
Based on our past experience, we're probably at the beginning or maybe at the top. Yeah? At that kind of, at the left flank of the curve. Yeah? Now whether that left flank is going to be very quickly we go to the top, or whether we continue to go a little further up before we hit the top, I don't know. Yeah? Sorry. Can I just take this? Yeah.
Sir, so you mentioned that you are supplied to railways as well.
Yeah.
Now railways is at least one area where some sort of activity is happening. So is it possible to talk about what kind of opportunity size that the market is, and whatever that 60,000-70,000 crore rupees of investment that railways is talking about,
Yeah.
how much can come to your side if possible?
See, the whole thing is a function of the budget, the railway budget. Now, if they invest in building capacities, then we go proportionate to that, right? Now, there are all kinds of investments that is being planned. One is safety investments. If there are safety investments, we don't participate. But if there's capacity increase, whether it's pure rail track, the tracks, more tracks means we need more locomotives means we need more compressors, right? So pure capacity increase, then we are a play. Now, if it is, what does 60,000 crores convert into? Very difficult to say. Very difficult to say. Right.
So in spares, we were talking about changing the design for a spurious
Yeah,
manufacturing.
that project is on.
So when would that?
It is progressive. It's
Catalyst does have a similar.
they do, but we have a different system, and we will be introducing it in phases. It's not like we start now and finish. It's an ongoing process. Sorry, you had a question.
So, the macro bit. In India, if I remove the after-sales services, we are around the industry we are 2,000 crores, right?
The total market would be about 600 million to 700 million,
Including after-sales.
including after sales. Yes.
Much lower. Because I understand industry
Well,
are more like 40% after-sales.
No, in India, no. India, no. India, no.
I just want to compare with China. China, the OE, excluding after-sales, I think they're around 10-12,000 crores, right?
The total market in China is about 2 billion.
Right, around 12,000
Yeah,
number.
yeah.
So just want to understand that 12,000 crore number which they are working at is like after adding a billion ton of steel, their capacity on power is humongous. So if I exclude those two sectors because, it doesn't look like they're going to add to 2020 a lot of power or steel, right?
Mhm.
So if I exclude that, what is the potential that the Indian market could be like? Because 12,000 crores we won't reach. Can we be double of current level by 2020? Assuming that steel and power, nothing happens.
Yeah, well, if you're going to grow at the GDP growth excluding steel and power, if you say we can grow at around 6%, then the compressor business could grow anywhere between 10 to 11%.
So you get there's enough application of compressors in terms of revenue potential, excluding these two sectors.
Oh, absolutely. I mean, a compressor is like a utility. Any factory that needs power, needs compressed air, right? So it will grow, but again, like I said, is it going to be 11% in every year or no? Maybe 7 the next year, maybe 14. Yeah.
You don't see the handicap that these two sectors may not do as well for you as.
You know, if you look at the past of India, these two segments were all not there. It was all government that was investing in it. It's only in the last 5-6 years everybody and his cousin jumped into power plants and burnt their fingers, right? So it's nothing, it's not an old business. It's just something that came and went very quickly. Sorry, yeah.
Excuse me. Yeah?
Sorry. Oh, I'm sorry. Can I get, yeah.
Of the 500 crores of international business, including exports, how much would you be selling under the LG brand?
5, it is the total sales, about 80%.
80% is sold under the LG brand,
Yeah.
including in Rotair.
Yeah, because only two entities is Bel Air and Rotair.
So 80% of 500 crores, that's 400 crores.
80% of our total, what is our total business of sales of units?
400 crores odd in subsidiaries and 100 odd crores in exports.
Yeah, but then there is parts, there is service. If you take patents, it has service income. So I'll have to sift through all that and then say, but it's only 2 entities that sell under their own brand. And soon one of them will shift to, I don't know, wants to shift to LG, right? Whether it will shift, I don't know.
And when you say that you're doing well internationally, the LG brand is getting accepted.
Yeah.
What's the benchmark for making that statement? Is it like if 10,000 compressors are being sold in France or wherever, you selling what quantum which makes you feel that incrementally you're getting, say, at least 30% share? Which
No, the reason why I'm saying we're doing well in the brand LG is you go to a market like the US, which is as competitive as a market like France. Now, we've gone in with the brand LG, and we are growing more than in France, which has got a Bel Air brand, right? But the reason for the growth is not just the brand, it's also the leadership. We have a problem of leadership and a whole host of other problems in France.
So even if you presume you're doing well,
Yeah.
what does it mean in terms of incremental share that you're getting? While the market is not growing,
Yeah.
let's say incrementally you're selling X number of compressors.
Yeah.
Are you getting an X amount of market share which makes you feel that you're doing well?
Absolutely. I mean, when you grow 30-40% in a market that is not growing,
Okay.
obviously growing market share, right?
So in terms of the incremental market, what is it? 30-40% is over a base
Yes.
that you
Yeah.
acquired. which
It's
is
hardly
smaller.
anything. I mean, you not even
That'll be
scratch
what?
the surface. Not even scratch the surface.
So you were just looking at your base and the percentage growth that you
Absolutely.
were achieving on that
Absolutely.
basis.
Absolutely.
And
One second. Go. Yeah.
We have conversion versus say last year, 2 years ago. In terms of the leads that you get.
Yeah.
We're doing your conversion rate.
Typically, our inquiry to conversion is anywhere between 20 to 30%. That is standard even in India. Yeah. So I don't think that is an indicator. Yeah. But to answer your question, have we calibrated our market share in a particular country? No, we have not even anywhere close to doing that level of calibration.
even in the local, so whatever regions you're operating, maybe in the US you're not across all states,
Yeah.
but states where you are present, if
We
10
are like
compressors-
where we have done significant sales like Indonesia, we measure market share and we set market share targets, right? But you go and set market share target in America, it's foolish because your number is so small. Yeah?
And you made a very significant statement when you said that your lesson number 1 was you could just go with the LG brand. You
Yeah.
didn't have to acquire the front end like in Rotair, Bel
Yeah.
Air. Maybe
Yeah.
Quincy was a different case because
Yeah.
it was a distributor.
Yeah.
So I guess you made that statement because you believe you're doing well on the LG brand.
Yes.
So is this number good enough to actually...
It's not only that we are doing well in LG brand in another country, it is also the fact that an existing brand has got has certain schizophrenic impressions in the market, which is very difficult for us to change. Like if a Bel Air is known as a small automotive compressor brand. Now you want to go and sell to an industrial company, that buyer is looking at Bel Air and saying, but Bel Air is not a big compressor. I don't want to buy a 110 kilowatt machine from you. 11 kilowatt? Okay, maybe. So that's the negative aspect of taking one of these brands.
But there was also a negative aspect to the LG brand made in India, which made you buy Bel Air and Rotair in the first place.
But you know, in this world of internet connected world, it doesn't take long for somebody to figure out that Bel Air product is made in India. So that advantage doesn't
So would you consider exiting from Bel Air, Rotair, the manufacturing facilities, and do what you're doing in Southeast?
We are not manufacturing the products that we are selling in Bel Air and Rotair from LG there. It is all produced here. What Rotair is producing is products for themselves. It's different from what we produce. They make portable compressors for the emission compliant markets, like in the US. Yeah.
So where are you losing money there? In Bel Air, for example?
It's the overheads.
So can you do away with the overheads and do a distributor model without the...
It's a distributor model today.
So the distributor model is losing money.
Exactly. It is a distributor model because what is that company doing? It is one more layer and it goes to a distributor. So, but this, it's a super distributor, right?
So what you do, the organic growth that you're achieving in Southeast Asia, in Indonesia and all the other markets where you just have an entity there, which is probably a warehouse or a sales entity, which is different from what you're doing in Bel Air, where you have something else in terms of overheads.
No, we don't manufacture anything in Bel Air. Everything is coming from here.
So if you had to be in this market, you would lose this money.
The way it is structured today, yes. The way it is structured today, the overheads are crippling. Yeah, we are not growing enough. We expected to grow. There were promises of growth based on which certain overheads were committed. Those overheads are not producing results, right? So we are losing money.
Can you use third-party distributors?
You can use third-party distributors, but you still need a sales organization to go sell.
Yeah, you mentioned that you have world-class.
Yeah.
But the key thing is leadership, and that's going to take time. You can't fix that problem in 6 months.
No.
So say if you have a plan to fix that over the next 36 months.
Yeah.
It's still much better to use a local distributor and probably even do a margin.
So the presumption is
no local distributor is going to buy a container of compressors. And you can't ship one-off compressor and be competitive. You need warehousing and quick shipment to distributors all over the world.
If you consciously, strategically take that decision, do that because you don't have the overheads of people.
Yeah.
It's the biggest overhead.
Yeah.
So you take this overhead.
Which overhead?
Warehousing overhead.
Yes.
Cost of shipping containers. Is that not a...
That's what we're doing in Indonesia.
Right. So this, since you have a world-class product, Europe and US can't do that.
We're doing that in the US. The point is, this was an acquired company. It came with a certain overhead, right?
I meant to grow incrementally in other states.
In which state?
Are you covered in the whole of the US now?
Yeah.
You are.
We have 30 plus distributors. Yeah.
So if you were to go back in time, you wouldn't acquire Rotair, you wouldn't acquire Bel Air, you would
We would not acquire companies for the sake of manufacturing or brand. Yeah, we will not. We will acquire, like I said, if at all, we will acquire distribution, if at all.
And one question on China. Last analyst meet, you spoke specific numbers on China, which again were very significant. You said that if you were at 155, China was at 90, and you had already got down to 120 without any change in the performance parameter.
Yeah.
I thought that was very significant because it was 30% lower than what you were doing in India.
Correct.
And
But
does that change now with your...
when you don't manufacture in China, then you need to manufacture from here and ship there. Then you add a factor of 1.3.
Oh, is it?
Yes, because it's shipment, duty, taxes. Yeah? So you need to now engineer your product to accommodate that, because you don't want to produce in China.
What if you take that product out of China and get it to maybe India or other markets?
Which product?
Then again, that factor was basically the freight.
If you want to produce in China, then you need to again go back and recreate the overheads that you've just shut down.
Okay.
Correct? So we want to produce in India and ship to China, which means our engineering cost target is lower. But now what I'm saying is the performance levels of the benchmark product are much lower than what we had taken earlier. So it's easier for us to engineer. That's the point I'm making.
Is it tough to just fall back and just shut down these entities, get out of China, get out of
If it was just a stock market play, you can get in and out.
No, from
right?
a business
But
perspective,
the point is, if you want to be a serious player, right, you leave behind negative consequences in every market that you exit.
No, this question is only because you think that you needn't have done it in the first place. So you should take a 10-year, 20-year perspective maybe.
Yeah.
But since you think that a front end doesn't have to be acquired, you did it and it's a lesson learned.
Yeah.
And you've already done it. Why not just reverse it and go on with what you would have done had you learned?
Which is what we're trying to do. We're trying to see what does that mean. Reversing means what? Because there are people costs, there are labor laws, there are antiquated all kinds of laws that we need to deal with, right? So it's not just, go there and, okay, now we shift to this. It doesn't work that way. Yeah. There are all kinds of inertia in the system we need to deal with, which we will. We will deal with it, but we don't want to just abandon a market and walk away, because then we're out of that market for a long time. Very difficult to get back. Yeah, I think we need to do last question. Otherwise, you guys, welcome to stay. Coimbatore is a nice place.
Poor market with the strongest competitive position that is India.
Yeah.
If you take out the water well,
Yeah.
in the last, not 1 year, but in the last 3-4 years, have there been any change in the market structure or in our competitive position? You mentioned market structure not much because the same set of players.
There is some change in the market structure because there are some new players that have entered in, but not in a very significant way. But they have. So everybody takes away a little bit, right? So to that extent, the industrial structure has changed. Has strength in the market changed in certain verticals? Yes, we've lost, which we need to regain. And to regain it, the old rules will not work. We need to build new rules, new methods of... Being an Indian company, we always took sales for granted, right? 50 years old, brand is there, you go set it, customer knows they'll buy. It doesn't work like that in the rest of the world. And we're beginning to realize it doesn't work like that in India either, right? So we need to go back and change. I think that's a lot.
Last year or maybe a year before that, when we met, I think, you mentioned that we have completed a catch-up in terms of technology.
Yep.
And we can now sell our products everywhere. And in the next couple of years, we will basically be moving ahead on technology versus competition. We demonstrate that in the next couple of years. So just wanted to understand whether, there has been any evidence that, or maybe you can run us through what are those developments where you move ahead on technology line.
Yeah.
And the connected question to that is that technology and price to some extent go hand in hand. So while we are moving up constantly on the back end and getting the best technology and efficiencies out, are you also in the mindset of pricing our technology, right? Like say in India, are we in a position that we are able to get what Analysts gets for the same kind of,
Sure.
or maybe going forward globally, would you be in a position to, once you establish that we are number one in efficiency, you want to reduce the gap in the pricing, so that to make this entire technology upgradation more sustainable over a longer term?
Sure. Evidence, he was asking, what is the evidence that you are your products are good. What is the evidence he was asking about? Is there a third-party certifying agency? Now, in a year's time, we will be number one. Now, that doesn't come without technology. Yeah? Now, is it a transformational technology? No. You know, technology has, in our frame of reference, small steps, incremental, and then one big transformation. So we are investing in both. So we get these small incremental changes every year, right? And that comes from not just design, but fundamentally building small little pieces of technology. Parallel to that is the transformational stuff, so which is also what we are working on, right? So we are hoping in the next 2 to 3 years' time we will showcase products that are for the first time in the world, right? But in the meantime, we will be announcing these, for us, small changes, but in the market, big evidence. In America, in KJI website, they're all number one. That's the thing. Yeah. You know, market sets the price. You know, we keep on working, like I said, brand. Yeah. If the guy doesn't speak properly, we have the greatest product. Yeah. If he doesn't speak properly, you get discounted, right? So the pricing engine is a lot more than just technology. It's about how you deliver that whole value proposition in every point that you're touched, yeah, by everybody, yeah. So we need to manage those. It's a long process.
The most important focus market for the next couple of years that you would look at in terms of geography or the international?
Americas, Southeast Asia, and the Middle East. Yeah.
And Europe?
Europe to the extent of Rotair, but we're not going to do any more adventures beyond that. So that way we will grow, but it's not a big number. Yeah, it'll grow.
So with these new products what we have introduced in the last 3 to 4 years, our addressable market in India should have actually gone up.
In some cases, yes. In some cases, it's like, for instance, if you take, I don't know, the one that I showed you with a curve, not this one, they are replacements of existing products, right? We've completely revamped our the line, just replaces. So the addressable market has not gone, right? We have introduced a lower end, so we have segmented the market. It gives us the ability to enter that market, but the market size remains the same, right? But things like that piston compressor, this oil-free screw compressor, that expands our addressable market. Yes, sure.
So ideally, now with your products in place,
Yeah.
you should be able to grow faster than probably.
Absolutely. Sure. I'm saying base minimum that she asked, what will I grow? I mean, GDP plus the inflation rate, I should be definitely doing it, right? Next year I can, because now I'm reasonably clear that in many of the businesses, capacities are beginning to coming to the brim. So the next round, they will have to make some investment. Yeah. Okay, thank you very much. I hope all of you have a safe trip back, and I look forward to seeing you next year. Thank you.
Jete